In conversation with Mr. Keki Mistry of HDFC. Thank you so much for speaking to CNBC TV 18. I want to start by asking you that what have the most pertinent drivers of growth been this quarter?
I would say it's a combination of many things, but the first and probably the most important is growth. So the individuals, now we have two categories of loans. We give loans to individuals and we also give loans to non-individuals. If you look at the individual component, we don't retain all the loans we originate, we also sell down loans. When we sell down a loan, we don't book profits up front. The income on those loans or the residual interest that we earn on those loans flows through to the P&L account over the life of the loan. So in the course of this year, we have sold loans aggregating to 8,249 crores. If we add back these loans sold, then the growth in the individual loan book has been 23%, which on a very large base like ours is a fairly healthy growth. In the non-individual component, the last 3-4 years the growth has been very slow. We have seen signs of pickup. We have clearly seen that the fourth quarter of the financial year saw a pretty sharp increase in the demand for non-individual loans. For the whole year, the growth has been 14% in non-individual loans, which is much higher than the last three years or so. But if we look at the breakdown of the growth in the loan book between individuals and non-individuals, then non-individuals this year has contributed 22% of the growth in the loan book, as compared to only 15% in the previous year, which clearly reflects an increase in the non-individual component. So one is the growth in the business. The two is spreads. Spreads have marginally gone up, very marginally. Last year spreads stood at 2.29%. This year's spreads stand at 2.32%. The third factor I would say is asset quality. Our asset quality continues to remain, touch wood, very strong. Our gross non-performing loan number stands at 67 basis points as compared to 69 basis points in the previous year. If we break up that 67 basis points between individuals and non-individuals, individual non-performing loan number stands at 0.51% compared to 0.53% last year, and non-individual non-performing loan is the same as last year in percentage terms at 1.01%. And I would say the fourth contributor to profitability has been the cost structure. So this year, touch wood, the costs have been low. We have had the lowest cost-income ratio in history. Our cost-income ratio for the year stood at 7.6%, which is frankly lower than what we had expected to see at the beginning of the year.
NIMs have marginally disappointed actually, and that has been the biggest source. I just got that wrong, sorry. NIMs have disappointed this quarter, and going forward, do you believe that there is a scope for NIMs to actually improve?
I don't think NIMs have disappointed. I don't know how these NIMs are calculated. Our net interest margin for the year stood at 4%, 4.0%. Last year it was 4.06%. Now if you look at NIMs, how do you calculate NIMs? You calculate NIMs by taking into account effectively the interest cost and the interest earnings. When you look at interest cost, the interest cost is a function of how much leveraging you carry in the balance sheet. Incrementally, what we've been doing is we don't raise equity. Since we've not raised equity, and since we have a high dividend payout ratio, which means a large part, 47% of our profits, we just pay out as dividend, we don't plow back enough money back into equity. And therefore, incremental growth always comes out of funding, out of borrowings. Borrowing cost obviously is higher than shareholders' cost. Capital cost 0. Borrowings cost whatever 8% or 8.5% interest. So if we funded ourselves more out of borrowings and not raised equity and sort of not restricted the dividend payout ratio, then logically, arithmetically, on a year-on-year basis, the net interest margin as calculated in that manner will necessarily decline by 4, 5, 6 basis points every year. That's natural. It has to happen. So therefore, we don't really look at NIMs. We can very easily increase NIMs by reducing the dividend payout ratio or by raising equity, but that would then result in a reduction in the return on equity. Our focus is to push our growth faster. Our focus is to manage our spreads in a very narrow band. So spreads, as I said, have gone up by 3 basis points. I would look more at spreads than at net interest margin. As I said, we can improve the net interest margin by doing a lot of things which will not necessarily be good for shareholders, in the sense that if we reduce the dividend payout ratio plow more of the more of the profits back into the business, then cost of funding on the balance sheet reduces. If that reduces, net interest margin goes higher, but the shareholders get less money in hand.
Spreads have marginally improved this quarter by about 3 basis points. Do you see that improving in FY16?
See, again, if you look at the last several years, 5, 6, 7 years or even more, our spreads have generally been in the range of 2.25 to 2.35%. Last year when we did our accounts, spreads stood at 2.29%. This year spreads stand at 2.32%. So in comparison to the previous year, spreads are up by 3 basis points. Now, our sense is spreads will remain stable. We don't usually take mismatches, so we give fixed rate loans out of fixed rate borrowings, floating rate loans out of floating rate borrowings. When interest rates come down and there is sufficient reduction in cost of funds to warrant a reduction in lending rates, we do that. As you have seen, we've reduced the prime lending rate by 20 basis points, which reflects the lower cost of funds. So I would say spreads would remain stable within that band of around 10 basis points.
Which brings me to the question that now that you've gone ahead and cut prime lending rates by about 20 basis points, do you feel that there is further room to cut rates going forward?
See, my sense is that inflation will continue to remain relatively muted. I see very little today to make me believe that inflation is going to go up. Yes, a couple of factors are there. We've had unseasonal rains. Rain outlook for the coming year for this monsoon period looks, I've read different reports, some saying good, some saying not so good. But there is enough food grain available with the government, which I'm sure they will use to make sure that food prices don't see an increase. Commodity prices are determined also by what happens in the rest of the world. And the world has clearly slowed down. And with the slowing growth in other countries, particularly countries like China, we see that commodity prices will continue to remain soft. India is a large importer of oil. So as long as oil prices remain muted and significantly lower than they were last year, I don't see any sharp pickup in inflation numbers. And if we were to believe that inflation will continue to remain muted, then I think, in my view, we could perhaps see another quarter to 25 to 50 basis points reduction in interest rates by RBI during the remaining part of the year. Now, it's very difficult to time these things. Would this happen in June? Will this happen post-June? I don't want to get into timing. But in the rest of the year, I would expect a 25 to 50 basis points reduction in rates, everything else being equal.
How are cities, or rather which cities are beginning to contribute in a very significant manner to your home loan business?
I don't think there's any one particular city which sort of stands out. But if we were to look at the 5 top centers of business for us, it would be Delhi NCR, Mumbai, Chennai, Bangalore and Pune. But when we talk of these 5 cities, it is not necessarily loans done in the heart of these cities. It is loans done in the outskirts of the cities. It is also loans done in the periphery of maybe 200 miles north, south, east, west of these cities. So it's pretty much widespread across the geography, across the country. Our average loan size in the current year has been 23 lakhs and 30,000 rupees. And if you take a 65% loan to value ratio, you're really looking at properties which are not much more than 41, 42 odd lakhs of rupees. So it's typically in the outskirts of big cities, tier 2, tier 3, tier 4 towns and cities. When we look at the average, if we look at the increase in the loan book, individual loan book this year, I mentioned earlier, it is 23%. If we were to look at how that 23% was contributed, the average loan amount went up from 22 lakh 10,000 last year to 23 lakh 30,000 this year, which means that the average loan amount increased by about 6%. So part of the growth was contributed by an increase in the average loan amount, which was up by 6%.
Given the demand-supply mismatch in urban areas, that has been a case for many years right now, have you seen any sort of revival taking place in urban areas now? And going forward, do you see any sort of correction in real estate prices in urban India?
See, urban India is a very large, urban India is a huge area. So it's very difficult or impossible to generalize for the country as a whole. But there are pockets in the country where prices have run up a lot. where where one can expect that there could be some correction in prices, or at least one can expect that there will be no further increase in prices in these areas. And there are plenty of other urban areas, including in tier 2, tier 3 towns, which are also urban, where prices are still fairly affordable, and therefore one would expect that prices will rise in line with inflation. So it's very, very specific to each city and each location.
This brings me to my last question. Can you give us an update on when that proposed IPO of HDFC Standard Life could be coming? And we believe that you've been in talks with Standard Life. Where have the talks reached?
So, as you know, foreign ownership limits in insurance were increased to 49% month and a half ago. We have been in discussion with Standard Life, and those discussions are still in progress. So basically the discussions are around where the final resting point for Standard Life will be. They have an option to increase their stake beyond where they are, and once the discussions are over, we will know where Standard Life finally will, what their final shareholding will be. We will transact that business, make sure that Standard Life goes up to that level, and thereafter look at filing for an IPO. Now, when we look at an IPO, there are several levels of approval that we require. We require approval from IRDA, we'll require approval from SEBI. So we have no sense on how long these approvals will take. But once the Standard Life transaction takes place, we would quickly try and prepare the documentation that is necessary to go and file for an IPO. My sense is, given the way things are at this moment, and obviously these things can change, IPO in 2016 looks imminent, and I would think it should hopefully be in the first half of the calendar year.
Sure. Thank you so much for joining in.
Thank you so much.
Wish you the very best of luck.
Thank
Thank you.